Initial jobless claim for the week of January 22nd, well, they moved down 26,000 from 286,000, which could get revised to 260,000. Continuing claims, a week in arrears, January 15th, 1,675,000, definitely a bit higher than expected. And sequentially, it's higher than 1.635 million, and it's definitely higher than the last week of last year, where it was 1.55 million, and that was, of course, a post-COVID low. If we look at durable good orders, down 0.9%. We got the direction right, but it is definitely a bigger miss than we anticipated, expecting down 0.6. Strip weight transportation, it jumps up to up 0.4, a little bit better than expected. Capital goods orders, non-defense ex-aircraft, a proxy for capital spending, business spending, unchanged, but last month revised up 0.3 from 0, and durable goods ex-transportation last month also upgraded along with the headline, so it's more of a balancing act over a couple of months. And finally, GDP, first look at fourth quarter, is 6.9%, much better than the 5.5%, and it harkens back to thoughts before Omicron hit at the end of the year. Obviously, they overstated the effects in the economy. That is a good number. And if you look at the annualized Q over Q at 6.9 versus last look at 2.3, boy, we are cooking in grease. Probably the best annual year-over-year GDP since 1984. If we look at consumption, 3.3 versus 2.0 last time. Now, here's a biggie. The GDP price index, up 6.9%. We're expecting 6.0. 6.1 is the current high. That's the highest going back to 81. So we are definitely pushing the envelope there. And the personal consumption expenditure, quarter over quarter core, a favorite, 4.9% versus 4.6. These numbers on inflation embedded in this, some of the Fed's best and favorite barometers for inflation are definitely running hot. And if we look at interest rates, well, we're down at 183 in 10s. We're at 118 in 2s, which had been higher. The yield curves flattening dramatically. And listen, the Fed shouldn't be pleased about flattening dramatically. If these things start to invert, what do you think the headline in every newspaper and every business channel is going to be? Recession, of course. So 10s to 2s, roughly the flattest since November of 20. 5s to 30s, even a better one to look at, in my opinion, because the 5 years a real finance rate. That's the flattest since early 2019. And, of course, right now everybody seems to be paying attention to what's going on with regard to Russia and the issues geopolitically. You know, we have this new airlift now for natural gas that harkens back to the Berlin airlifts after World War II. But I want to know who's going to airlift us at some point in the future, because Build Back Better has the same underpinnings that have Europe in trouble with no energy. Andrew, back to you.
Actually, I'll take it, Rick. Quick question for you. GDP price index, how is that calculated? That's not a number that we talk about all that frequently.
Well, the price index basically is looking at the amount of horsepower in the economy and the price associated with it to give us the final level numbers. So if you look at GDP, there's a dollar amount, and comparing that with regard to how the pricing components pushed it up there. And then when you look at the core personal consumption expenditure, of course, core is ex-food and energy, and some of those numbers historically have been much more accurate than other variables, which they continue to change, like CPI and PPI metrics.
All right, we wanted to talk with you about what Stan Druckenmiller said. I'm told we don't have time right now, but Rick, we will definitely get to it tomorrow. So good to see you. Thank you for the quick advice and the headlines on all this stuff. Steve Leisman joins us with more. He's been digging through these numbers, too. Steve, pretty strong numbers, pretty incredible numbers when it comes to the economy.
Yeah, and I think that's a good, it's an important point there. We're going into a very weird moment here where we're going to have these negative numbers or detractions from the growth numbers because of Omicron. And I'm actually, of all of the data points I like, I'll give you the top two, not GDP. That's important. Come back to that in a second. It's the jobless claims numbers. I was wondering about if we went into this downturn, because labor is so hard to find, the extent to which companies would hold on to their labor during this Omicron wave. And the idea that we didn't go up, that we're still at 260, we came down a little bit, still some seasonal distortions in there, that's okay. But we're not going up. That's an important part, I think, of what we're going to see, hopefully, through this Omicron wave here, and not get huge numbers of jobless. The next number I like the best is the durable goods numbers, ex autos and ex transportation, being up 0.4. That's a good number. We know we still have problems. I'd love to see them being worked out here in the autos department, and Boeing has issues on all its own. But working through those, but without those things, we still have some good capital investment going on in the economy. Third is GDP. If you're going to go into some bit of weakness, better to have strong numbers behind you. And that's going to help us, I think, forward. I will point out a big chunk of this was inventory. And on what Druckenmiller said very quickly, Paul McCulley told me yesterday, the era of leveraged beta is over. This is now the time for alpha. And I think that's exactly what Stan's saying as well.
Okay.